All right, this is Dr. Reese. I'm going to walk you through using this Excel workbook. The Excel workbook we're using is entitled Bolivian Imports First Year Forecast Workbook. So again, this is the title of the Excel workbook we're using, Bolivian Imports First Year Forecast Workbook. You'll find that on the course site. We want to be able to use this worksheet to create an integrated forecast. To do that, first thing we need to do is add all of these assumptions here. Now you'll remember that we did a worksheet. Bolivian Imports First Year Forecast Worksheet. So we did a worksheet where we captured all this information by units sold, the selling price, cost per unit, the office/warehouse rent. This Excel worksheet is almost identical to the worksheet that you did with pencil and paper. However, it does have three new items. One, it has the percentage of sales that are made on credit. In other words, the customer won't pay Bolivian Imports cash. They will take the item on credit and then there'll be an accounts receivable. Two, there's the accounts receivable collections days. You don't have that on the worksheet that you've already prepared with the assumptions. The third item you don't have is required beginning inventory. The fourth item you don't have is interest on notes payable. This forecast is set up to track the cash flows of the enterprise during the first year. In the event the firm runs out of cash during the first year, this Excel worksheet is designed to automatically borrow money to bring the cash balance to zero. And of course, we will have to pay interest. So this is the interest rate that we're going to pay on the money we borrow. I'll talk about that more later. So on the assumptions worksheet that you've already prepared, you have all of these items except for four. The four items you do not have are credit sales, accounts receivable collections days, required beginning inventory, and the interest rate on notes payable. Everything else you already have. You have units sold, selling price per unit, cost per unit sold, office/warehouse rent. Those items you already have. So we're going to populate this part of the worksheet with the information we have. Here you see I've added the units sold and the selling price per unit. Here you see I've added the cost per unit sold. Here you see I've added the office/warehouse rent for each of the first 12 months. Now we're going to have to add the new items. We're going to add the percentage of sales on credit, and we're going to add the accounts receivables collection days. Now this will be a good time for me to help you understand how we use these assumptions on the Excel spreadsheet. If you have a well-designed spreadsheet, or you shouldn't have to go into any other section than the assumption section to test different scenarios in your forecast. Why do we do forecast? We don't create forecasts because we're trying to determine exactly what's going to happen. That is not the point of a forecast. The point of a forecast is to understand what major factors drive revenues, expenses, cash flows, and to understand how sensitive the forecast is to those major drivers. In other words, we're trying to figure out how big is the box we're trying to pitch into. If the box is very small, then we need everything to go right to get a good and profitable operation. If the box is very large, then there are a number of sets of circumstances that could lead us to a profitable operation. The Excel forecast is designed to help us figure out how big is that box. Is the box really tight? In other words, Am I trying to hit the top of a pin from a half a mile away? Or is the box really large? I'm trying to hit a tank that's a block down the street. So those are two very different kinds of exercises. If I'm trying to hit a tank that's a block down the street, I don't have to have really good aim. Tanks are big and a block is not very far. But if I'm trying to hit the head of a pin a half a mile away, I probably got to be one of the best marksmen on the planet. Again, when we do forecasts, we're trying to understand how tight is the box? Is this going to be easy to do, or is it going to be hard to do to get a profitable operation? So that's what we're trying to do. What we need to add to this forecast, which we didn't have before, which is the percentage of sales that are on cash versus the percentage of sales on credit. Now, the reason we care about that is it's going to impact our cash flow. When we sell something for cash, we collect the cash right away. But when we sell something on terms, in other words, we give the customer terms, we allow them to take the goods and we bill them later, then we don't get cash right away, and so that ties up cash for the business. How much we do in credit sales and how long we give the customer to pay is going to impact our cash flow. So now I'm going to populate the percentage of credit sales for this particular version of this forecast, and I'm going to put in the number of accounts received collection days. Now, in this case, I'm going to set the accounts receivable collection days at 30 days. In other words, 1 month. Customers can take a grinder, but they're going to have to pay us 1 month after they take the grinder. They take many grinders, but they're going to have to pay us 30 days after they take the grinder. Now, I mention this in particular because this is the one assumption that we're going to hardwire into this worksheet. In other words, I'm going to put a number here under accounts receivable collections days. However, if I change that number, it's not going to change how the spreadsheet works. So this is the one assumption in this assumptions area that we are not really going to be able to change. We could change the number, but it wouldn't actually make the worksheet operate differently. So this number is going to be 30 days, and we're not going to be able to change it. So I'm going to put that in now. So at this point, you see that I put in the accounts receivable collection days. This is the one assumption in this worksheet we cannot vary. I'm going to populate the percentage of credit sales. Now that is a number we can change, and it will impact our cash flow. Now right now I have this set at 100%. I'm going to actually change this to 0% for right now. So now I've set the percentage of credit sales to 0. After we populate the income statement on the worksheet, we're going to play with this number. We're going to play with the percentage of credit sales to see how the percentage of credit sales impacts how the income statement works. If you come down here to the income statement, you'll see that we have two categories of sales. We have cash sales and we have credit sales. So this percentage of credit sales is going to impact what we see down here for cash sales and what we see here for credit sales. Now we're going to add the required beginning inventory. We're going to add the required beginning inventory. To do that, we're going to have to go back. We're going to have to go back to our case study sheet. We're going to have to go back to the Bolivian import first year forecast worksheet to find out what our required beginning inventory is supposed to be. I'm going to populate that, but I'm going to show you where I got that information from. Now this is important because ultimately it's going to impact our cash flow. It's going to impact our cash flow. How much inventory we need to have at the beginning of each month is going to impact the firm's cash flow because we have to buy that from the people in Bolivia and get it shipped here to America. I have populated the required beginning inventory. I want you to notice something though. We plan to sell 200 units in January, and our required beginning inventory for January, in other words, January 1 is 200 units. We plan to sell 300 units in February, and our required beginning inventory for February 1 is 300 units. So in other words, our required beginning inventory is equal to the amount we plan to sell that month. So again, our required beginning inventory on March 1st is 400 units, and we plan to sell 400 units in March. Our required beginning inventory for May 1st is 500 units, and we plan to sell 500 units in May. Our required beginning inventory for June 1st is 500 units, and we plan to sell 500 units in June. This is how the required beginning inventory is determined. The last thing we need to populate is the interest rate on the notes payable. And this is the annual percentage rate. That's what APR stands for. Now, we've populated the interest rates on notes payable, and we've set the APR to 12%. Now, I've done this as a matter of convenience. I picked 12% as a matter of convenience. Why is that? Because there are 12 months in a year, and we say our annual percentage rate is 12%, then our percentage rate for each month is going to be 1%. 12% divided by 12 is 1%. So each month, the interest that we would pay on any outstanding borrowings would be 1% of whatever is outstanding. So it will make it easy for us to check if our spreadsheet is working properly. So here we're looking at the opening balance sheet for Bolivian imports. Specifically, this balance sheet shows the assets, liabilities, and equity for December 31st, 2006, which is the same as January 1, 2007, which is the starting date for this business. We have cash on hand of $2,250. You may recall K invested $3,000 in the business. So K invested $3,000 in the business. She's the sole owner of the business, so she put $3,000 in. So if you want to do the debits and credits, that meant she debited cash for $3,000 and she credited owner's equity for $3,000. With that $3,000 worth of cash, she had to buy her initial inventory, 200 units at $3.75 a piece. She spent $750 on that. So $750 of that $3,000 is tied up in inventory. So she has total assets of $3,000. She has no debt. She has her equity. So now this balance sheet balances. Total assets of $3,000, total liabilities and equity of $3,000. So what we're going to do now, we're going to populate the income statement on this Excel spreadsheet. We'll use the same math procedures that we used when we completed the Bolivian imports first year forecast worksheet. First thing we need to do is calculate sales. We're going to calculate total sales. Now, the one thing I have done is I have divided sales into cash sales and credit sales. But right now, we're just going to work on calculating sales. Our assumptions indicate that 0% of our sales are credit sales. In other words, sales where the customer can take the goods, not pay the invoice, and we have an accounts receivable. Again, the way we're going to calculate the total sales, we're going to multiply units for January times the selling price for January. Let's go to cell B33. So this is cell B33. In Excel, cells have addresses. The column is B for this cell. The row is 33. That makes this cell number B33. Now here we have a formula bar bar, it shows the cell address and it shows the formula in that cell. Now the formula in this cell is parentheses 1 minus B5 times B2 times B3. B2 is the number of units that will be sold in January, and B3 is the selling price of those coffee grinders in January. So B2 times B3 are going to give us the total sales. Now we're multiplying this by 1 minus B5. Now in this case, B5 is the percentage of sales that are credit sales in January. In this case, it's 0. 1 minus B5 is going to be 1 minus 0. And so we just are left with B2 times B3, which is going to give us our total sales. If we go down here to cell B33, we're going to end up with our total sales. So I'm going to go ahead and populate that now. So our total sales for January are $1,400. Let's go ahead and do the credit sales. We calculate the credit sales in cell B34. In cell B34. That cell is in column B and it is in row 34. So the address of this cell is B34. Now, I wanted to refresh you all on these cell addresses because during the rest of this video and subsequently in class, we're going to be working with Excel a lot. And so I'll be referencing cell addresses. So you need to be comfortable navigating around an Excel spreadsheet. Now the formula in cell B34 is B5 times B2 times B3. Now we know B2 times B3 gives us total sales. That's 200 times 7, so that's $1,400. And we multiply that by B5, and B5 is the percentage of credit sales in January. Now we've set this to 0, so 0 times anything is going to be 0. Let's populate that cell. So now we see that the credit sales for the month of January are 0. To illustrate how this percentage of credit sales functions works, I'm going to change the January credit sales to 50%. I'm going to change it to 50%. So half of our sales are going to be credit and half of our sales are going to be cash. So that means that instead of showing total cash sales of 1,400, we should see 700 there, and we should see 700 in credit sales. So I'm going to change this assumption now. And I just changed the percentage credit sales to 50. And now look what happened. Our cash sales are now 700, and our credit sales are now 700 for a total of 1,400. Now I'm going to switch the credit sales back to 0 while we populate the rest of the income statement, but I wanted to illustrate how this assumption works, how this percentage of credit sales assumption works. So I'm going to switch it back. Now that we've calculated the cash sales and credit sales, I want to calculate total sales, which is going to be just the sum of the cash sales and the credit sales. So total sales will appear in cell B35, and the formula for cell B35 is B33 plus B34. So in other words, we just add the cash sales and the credit sales to get total sales. So I'll populate that cell now. And as you can see, our total sales are 1,400 for January. Now we're going to populate cost of goods sold. Again, we're going to use the same math that we used on our worksheet. So it's going to be units sold times the cost per unit. So units sold are going to be 200. Cost per unit is going to be $3.75 for each grinder. So we multiply 200 times the 375 and we'll get our cost of goods sold, which will go here in cell B35. Now you can see that our cost of goods sold for January is $750. Now that we have our total sales and we have our cost of goods sold, we can calculate gross profit for January. Gross profit is going to be total sales minus cost of goods sold. So that'll be our gross profit. Gross profit is in cell B37. And here's the formula in cell B37. And that formula says B35 minus B36. So B35 is total sales. B36 is the cost of goods sold. We subtract those two and we get gross profit. And again, that will go in cell B37. So we see our gross profit for January is $650. Now we're going to have our office warehouse expense. Again, we're going to have our office warehouse expense. That's in cell B39. So the formula for cell B39 is just B10. So we take that value straight from the assumptions table. So for January, office warehouse rent is $300. We take that from B10 and that goes right on to the income statement in cell B39. I'll populate that now. The last two things we need to do is to populate this interest expense cell for January and to calculate net income for January. Let me show you the formula for interest expense. Interest expense is in cell B41, and the formula for interest expense is B14 divided by 12 times B24. Now, what is B14? B14 is the interest rate, the annual percentage rate interest for January, and that's 12%. We say B14 divided by 12 because we're calculating interest for a month. And we multiply that by B24. Well, what is B24? Let's figure out what B24 is. B24 is here on the balance sheet and it's notes payable as of January. B24 is notes payable, in other words, debt outstanding, as of 12/31/2006, which is the same thing as January 1, 2007. So now we see that K didn't have any debt outstanding on that date. So 1% of 0 is going to be 0. All right, so we're going to have 0 interest. I'm going to populate this cell B41 now, and we should have 0 there because it's going to be 12% divided by 12 times B24, which is notes payable, and that is 0. I should note, if somewhere during the first year K runs short of cash and our cash balance becomes negative, then this spreadsheet is designed to borrow money, put that value in notes payable, and then this interest expense number would be a number other than 0. It would be 1% times whatever notes were outstanding at that particular month, or specifically at the beginning of that particular month. Now we can calculate net income for January. That's going to be in cell B43. We're in cell B43, which is net income. The formula in that cell is B37, which is gross profits, minus B39, which is the office expense, minus B41, which is the interest expense. We take gross profits, we subtract office expense, we subtract interest expense, and that leaves us with net income. So I'm going to populate that now. So our net income for January is going to be $350. So again, our net income for January is going to be $350. We can populate the rest of the income statement in a similar fashion as I have done now. So I'm going to actually just do that. And you should do this on your own version of the Excel worksheet. Now that we've finished January, I'm going to populate the rest of this income statement for February, March, April, May, all the way through December. Now, as you can see, I populated the income statement from January, February, March, all the way through December. We have total sales of $1,400 in January. $2,100 in February, $2,800 in March, $3,500 in April, $3,500 in May, June, July, August, September, October, November, December. And similarly, we have calculated gross profits for all those months, office expense for all of those months, and net income for all of those months. We have net income for January of $350. We have net income for February of $675, for March of $1,000, for April of $1,325, and for the months from May through December, we have net income of $1,325.